The Fed just gave us some insight, and it's leading the stock market to actually turn green today. But is it justified in doing so? Make sure to stay to the end to see my commentary. Is the Federal Reserve charting the next U-turn, and does that matter? Well, yes and yes. In this video, we're going to talk about both. Look, if you've been watching me for at least, well, 9 months now, you remember my videos back in January and February and March where I made it crystal clear that the bottom of the market tends to align with the Federal Reserve U-turning. That's what I've said since the beginning of the year. That doesn't mean I've perfectly listened to my own advice, but it has historically been very true. In 1987, the markets bottomed when the Federal Reserve U-turned and set the precedent for bailing out markets. In 2003, the Federal Reserve ended the dot-com bubble by U-turning. In March and February of 2009, the Federal Reserve ended the Great Recession by U-turning. Congress U-turned 6 months before that, didn't do anything until the Fed U-turned. In December of 2018, markets bottomed when the Fed U-turned. In March of 2020, markets bottomed when the Federal Reserve U-turned. If you've been watching this channel, this should just be a reminder for you that the bottom tends to be associated with the Federal Reserve U-turn. Now, I've had a belief that this time, which, remember folks, the most dangerous words in investing are "this time is different." But I've had a belief that this time around, markets would be educated, that's a bad thing to assume, but that markets might believe that the Federal Reserve will U-turn at some point and will price in that U-turn earlier. The problem with that is, pricing in the Fed U-turn has been a fool's errand so far. Consider the rallies that we had in March or August of this year, all of which have been crushed and led us to new lower lows because the Fed didn't actually U-turn. If anything, they were just getting started. And so this is the danger of pricing in a Fed Reserve U-turn too early. Now, we have Charles Evans from the Federal Reserve, who's provided us some more perspective on when the Federal Reserve actually expects to U-turn, barring any outsized shocks, which is fascinating that now they're suggesting barring any outside shocks, and you can't blame them for that because the first time around inflation was transitory until we got Delta, and then it was transitory until we got Omicron, and then it's like, dang it, we've had more shocks. Okay, never mind, it's not transitory anymore, but it's still decent. It's not so terrible. Oh, wait, now war with Russia and Ukraine. Yeah, this is bad. Right? So other things can make the Federal Reserve's policy path much more restrictive, and those things can be out of their control, but that is not to excuse them for being so late. I mean, after all, when you have people like Jeremy Siegel implying that they are, or I should say, bluntly saying that they're afraid because the pendulum has swung too far to the other side, well, then it makes you really want to pay attention to what Charles Evans just said. First, Jeremy Siegel, here.
I'm afraid it's like a pendulum. They were way too easy, as I've told you and many others through 2020, 2021. And now, oh my God, we're going to be real tough guys until we crush the economy. I mean, that is just, to me, absolutely poor monetary policy would be an understatement.
Now, you can't blame Jeremy, okay? He's one of the guys who was screaming that the Fed wasn't doing enough last year and is now doing too much. Listen to this, and then after you hear this, I want you to hear comments from Charles Evans, which just came out this morning, which in my opinion are leading the market to rally. But first, a little Jeremy.
Scott, I find it very amusing. A year ago at that September meeting, when we had booming commodity prices, housing prices rising at the fastest rate in post-war history, when we had all commodities going up at rapid rates, Fed Chairman Powell and the Fed said, we don't see any inflation. We see no need to raise interest rates in 2022. Now, when all those very same commodities and asset prices are going down, he sees, stubborn inflation that requires the Fed to stay tight all the way through 2023. Makes absolutely no sense to me whatsoever. Way too tight. We do not have to get anywhere near that level to stop inflation, because all the inflation is basically stopped. I mean, you had a headline just came across 3 minutes ago. Oil back to January levels. That's before Russia invaded Ukraine. You can see what's happening to commodities. We're going to get the Case-Shiller index next week. It's going to show no increase or a decrease for the first time in years. And that's a lagged indicator. On the ground, commodity, all the prices are going down. The only thing that's not going down is wages. And by the way, wages are in catch-up mode. Don't argue they're pushing inflation. They're lagging inflation. I mean, the workers are trying to get what a little bit back of what the inflation happens to be. I think the Fed is just way too tight. They're making exactly the same mistake on the other side that they made a year ago.
He's not wrong. The Fed has been pretty dang slow at reacting, and unfortunately, the stock market that we look at today is the result of the Federal Reserve's poor decisions. I don't want to say they were failed, because they're going in the right direction. They're just probably 3 to 6 months too late, both on the front end and the back end. Remember, they were still printing money in March of this year when war broke out. That's just like stupid. It should have been like an emergency off switch. Anyway, let's take a listen to Charles Evans right after a message from our sponsor. Now, if you're in New Jersey, this next one is for you. Today's sponsor is Mojo, a sports stock market that lets you invest in the careers of athletes. Now, remember, when it comes to betting, you don't want to bet everything, okay? This is supposed to be entertainment, something that you do on the side, kind of like when you go to Vegas and you have a great time and hopefully win some money. But folks, this is pretty incredible. Love or hate a player, you can now go long or short instantly and build a portfolio in minutes of players you want to go long or short on. Like, it's the holy grail for sports fans and the chance to cash in on your position and finally invest in what you know and truly love. Here's how it works. The app currently offers the NFL with over 300 skilled players across quarterbacks, running backs, wide receivers, and tight ends. Each athlete stock on Mojo has a share price that rises and falls in real time based on on-field performance, news, and anything else that might affect expectations for future performance. Prices move all year long, so there is no off-season. Check out, for example, Daniel Jones or Zach Wilson. Now, Mojo's guaranteed payout formula is based on objective stats, so you always know exactly what the stock is worth at any given time. Think an underrated rookie is a rising star? Go long. You can even short a stock and profit as the price falls, and you can buy and sell instantly and hold a stock for as long as you want, a play, a game, a season, or even entire career. Now remember, right now, this is for those of you in New Jersey. It's available on iOS. You can download the app Mojo right now and get your first stock totally for free, worth up to $10,000. Click the link in the description down below for your first stock worth up to $10,000. When does Charles Evans, the president of the Chicago Federal Reserve, believe it is going to be time for the Federal Reserve to actually U-turn? Well, first, let's set the stage in terms of how high we actually expect the Fed to go. Right now, the Fed funds rate is sitting at about 3.25%. And Charles Evans tells us where they expect to be by the end of the year and if we're going to hike rates next year. Then we'll talk about when the U-turn could happen.
View for the end of this year is that the federal funds rate will be in the 4.25% to 4.5%. So there's still a ways to go this year. It's been a very challenging time. Prices have gone up. Relative prices have gone up. Cars, durable goods in the U.S., many segments. But now it's broader. And that's, I think, the concern sort of globally. This is a global inflationary environment with high energy prices, and the concern that it spreads more broadly throughout, every economy is one that central bankers are going to have their eye on. And so I think this type of rate environment is here for a while.
So heading another 1 full percentage point higher towards the end of this year and beginning of next, potentially having another increase, taking us to either 4.25% or 4.5%, with the median SEP, Summary of Economic Projections, bringing us to 4.6%. Got it. So higher for longer. But when is the U-turn? That's what we care about. When is the U-turn in the mind of Charles Evans? Here we go.
Yes, I'm Charles Evans, here to just remind you about September 30th, the deadline for sending your wire for House Hack. And remember, you can also join the programs on Building Your Wealth and live streams with Kevin doing fundamental analysis every day the market is open. Link down below. Now to the real Charles Evans.
By the spring of next year, we're going to get to a funds rate that we can sort of sit, watch how things are behaving, and if inflation starts to come down, things will be more restrictive and we would want to adjust downward.
So March or April, spring-ish of next year is when we're thinking maybe the Federal Reserve might consider adjusting downward. Now, unfortunately, this is a narrative that has been relatively consistent at the Federal Reserve, that once we get to a specific level, we're going to adjust downward. And this has a lot of markets pricing in the belief that, okay, great, once we get to the spring, we'll adjust downward. But I don't actually believe that is really going to happen. I believe we're, at this point, more likely to hit that 4.6% Fed funds rate. Then the Fed's U-turn is going to take the shape of a pause, but not a decline. I would not be surprised that the Federal Reserve actually waits until the end of the year, with, by the way, markets presently pricing in a November U-turn in actually dropping prices. That, in my opinion, makes Charles Evans slightly dovish. However, because this commentary just came out this morning, it is giving the market some hope. It is just my belief that we want to approach this with some cautious optimism, which is kind of what Evans has as well, optimism.
The median forecaster to get to the peak funds rate, assuming, by March, assuming there are no further adverse shocks. And if things get better, then we could perhaps do less. But I think we're headed for, that peak funds rate, and that offers a path for employment, stabilizing at something that still is not a recession. But there could be shocks. There could be other difficulties. Goodness knows, every time I've sort of thought the supply chains were going to improve, that we're going to get auto production up and used car prices down and housing and all of that, something has happened. So cautiously optimistic.
Now, I don't think this video would be complete without giving you a little bit more anger from Jeremy about why the Federal Reserve is screwing up so badly. He goes into talking about how commodities are plummeting and many forward indicators of inflation are plummeting. And he's not wrong. Lumber's down over 70%. Housing indicators are turning, but they substantially lag in inflation readings by 6 to sometimes up to 12 months. Just let's close this one out, not only with a reminder on the deadline on September 30th for House Hack and the course member streams and lectures, but also let's close it out with Jeremy's rant.
What does the record decline in the money supply mean? I mean, what does the collapse in commodity prices mean? What is the lag construction of these housing indicators that are 40% of the core inflation? What is he actually looking at? I mean, he's looking at 3-month annualized core inflation that is a lag. While we all look at market, look at what does the stock market do? It looks at market-oriented data. And that's what the Fed should be looking at.